Hi, it's Helen Tarrant. Welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant. Now, one of the things I want to actually explore with you today is the value of commercial property. Now, there's been lots of back and forth. Now, if you're going from residential to commercial, a lot of people will say, hey, that property was sold in 2018 for $450,000. Why is it in 2022 or 2021 or 2020 the property is now being sold for $850,000? I'm paying inflated value. I'm paying traded price for this property. I shouldn't buy it. Now, one of the big things about commercial property is that the value isn't always determined by the land, by the actual property itself, so the building or the shed and everything else on it, and it's not always determined by the tenant that's in there. So all of these things are moving factors. Just because a property was sold in 2018, one of the things you cannot define is what state it was sold on. So it could have been sold on as a rundown property, it could have had asbestos in the property, it could have had roof leaks in the property, and it could have been vacant for 2 years before then. So it would have been sold below market at, say, $450,000, where the real market value may be $600,000 or $650,000, and someone has come in there and they've spent $200,000 doing it up, putting a brand new roof on it, getting rid of the asbestos, maybe putting partitions in, putting in a mezzanine floor, attracting a tenant, and then giving the tenant incentives and maybe fitting it out to the tenant's purpose to actually get the tenant in. And now, because of the tenant and the quality of the tenant and the quality of the lease, the property may be valued at $850,000. That's no different from you doing a renovation in the residential space, where you're buying a rundown property and you gutted it, you spent the money on it, and then you got the uplift. It actually is no different, but the process is a little bit longer, and the process is a little bit undefined in the beginning. So while you might see a property double within 3 years and think, wow, what great value, I'm buying inflated as a buyer and I shouldn't do it, that shouldn't actually put you off buying that property, because you see, the rent may not be inflated. You see, the property and the quality of works that's been put into the property could last the next 20 years. So you see, they had to remove asbestos, and it might be 50 grand for them to remove the asbestos, bring up the electricals and the plumbing. That's going to last forever on the property. If with a mezzanine floor, that's going to last forever on the property. It's going to increase the lettable area in that property forever. If they put a quality tenant in there, then that tenant is likely to stay for the next 5 or 10 years, and you reap the instant rewards of it. Now, if you're buying a set and forget property, this is actually exactly what you're looking for. You're looking for the ripe fruit, where people have actually done the work for you and they're handing you a property that is all completed, so that there's no more work to be done on that property, and that there's nothing else for you to do except to collect the cash, whether it's $20,000, $30,000, $40,000 or $50,000. Now, so the only question is, when you are buying a property on that, is that property you're buying totally clean and without any worry? So that's what your due diligence is about, is making sure the tenant pays their rent, making sure all of the work that was previously done is totally done on it, make sure there's no follow-ups for you to be done in the next 3, 5 or 10 years. I mean, with every property there's always going to be maintenance costs, but remember, if you're buying a set and forget property, you are actually picking up the right fruit that's of someone else's labor, so therefore there should be nothing more for you to do. So if you are looking for this type of property, then what you should be doing as your research is not taking into account, 3 years ago it was sold for half that price or half that value, and therefore I'm not paying for it. You actually should be looking at the property as on its own, as a separate, unique deal, whether that deal works for you as it stands. So if it's a property that's 7% yielding in Sydney, then buy it, because 7% yielding property in Sydney doesn't come up straight away. So make sure you do your due diligence. As long as it gives you the cash flow and that matches, and the bank is willing to value the asset to its current value at the contract price, then do the deal. If it's not valued at the contract price, then go back to negotiate. If the tenant is not on a substantial lease, then it's not worth that value. If the tenant is not a professional or a high-level tenant and the fit-out's not done perfectly, then that's not worth that price. But remember, if you are going for a set and forget and not an uplift deal, you are looking from a different point of view. You're looking for a clean property over a property that is run down. You cannot mix the two. If you mix the two, that is where you get into trouble. What you secretly are hoping for is an uplift property wrapped up in a set and forget, and that doesn't exist. You have one or the other. Now, when people talk about future potential, now future potential, it can be a lot of things. It can be increasing the value of the property through more lettable areas. So you might have a parking space, you might have a shed area, you might have more land that you can develop on, or increasing the value of the property because you can go up, build up, or you can develop on the land, or you can subdivide, or you can make one tenancy, two tenants. So those are things that increase value, but they may not be available to you straight up. They actually may have to wait 3, 5, or 10 years until your current tenant actually vacates for you to do that. So some of the things that you're looking for, if you're looking for straight up, set and forget, look for a clean property, and the value that it was purchased for 3, 5, or 10 years ago is irrelevant. Look at it as it is now and what the tenant and what the return you're going to get, and the bottom line is in terms of cash flow for you is now and whether it stacks up on valuation. If you're looking for an uplift, go for a rundown dump that you would not touch normally, that it's got roof problems, asbestos, tenant not on substantial leases, leak and water leaks, all of those. Look at that. But the under market rent the tenant's getting that you might have to kick out the tenant, look for that. That is your uplift property. Now, if you want a property with future potential, you can buy a property that has a land component or has something that if this tenant does leave, you can then swap out for 2 other tenants as well. So, or you might be able to improve the value of the property by adding a mezzanine floor or doing some capital works on it. So those are the differences. So please don't let previous value influence your current purchase, especially if you're looking for a set and forget, because the value of the commercial property are defined by 3 things. Firstly, your tenant. Who is the current tenant in there? On the scale of, are they a brand name tenant, or are they a mum and dad tenant? Are they a professional tenant, trade tenant? How blue chip are they compared to an everyday tenant? Secondly, the tenant, the actual property itself. So if you are buying retail at the moment, you are going to get a better yield, but if you're buying warehouse, you're going to get a lower yield, just because the current market, there's so many people looking for that set and forget type of property in a warehouse type property tenant. So it all depends on the current trend as well. And finally, number 3, what do you look for and what determines that value? It is actually the quality of the fit out, the quality of the building, and the location, all of that wrapped into one, so that you return, how clean it is, whether it becomes set and forget. So that is the other thing that defines the value of it. So remember those 3 things when you're looking at a property and assessing a deal now, rather than looking backwards in the past and rejecting a deal because it was purchased, $300,000 or $400,000 less than what's currently advertised in this current market. So if you need help with a deal, you want us to help you analyze the deal, or you just need a hand in working out if it's the right deal for you, reach out to me on helentarrant.com or email me helen@commercialproperty.com.au. Don't forget to hit the bell and subscribe, and I'll see you in the next episode. Bye for now.